Over the weekend, strikes on Iran and Iran's retaliation to those strikes changed the near-term demand picture for two markets at once, defense and oil, or defense and oil. And we're going to talk about it today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Oil and defense stocks have both moved sharply higher in the past couple of months. That was a function of geopolitics. In early January, you may remember that President Trump warned that if Iran targeted their own civilians, then the regime itself would become a target. It's possible that because they did attack their own population during those protests and saw no immediate reprisals, they did not believe intractability in the talks about ballistic missiles and their pursuit of a nuclear weapon would have any immediate repercussions. We don't know what they were thinking before the strikes, but we know what they're thinking now. Retaliate against anyone and everyone in the region. Iran launched strikes against Israel, several U.S. bases and in other countries, as well as some civilian targets in the UAE, Bahrain, Qatar, Kuwait, Saudi Arabia, Iraq, Jordan, and Oman. And the latter was a bit surprising given that Omani Foreign Minister Badr al-Busaidi, if I'm pronouncing that correctly, has been serving as a mediator in these diplomatic talks. So what does this really have to do with us as investors? Well, over the past several months, as I was alluding to, we've seen defense stocks march steadily higher. Actually, names like Raytheon and Lockheed in particular, have been marching basically from the lower left to the upper right for some time now. Oil was basically flat for the month of December, and that changed in the first week of January after those remarks. We started to see it rally quite a bit. And really, I think we've got a couple things going on here. In late January, it was January 29th, if memory serves, the chairman and CEO of Lockheed Martin, he made a public statement after Lockheed and the United States reached an agreement that they were going to increase their THAAD capabilities. THAAD is an anti-missile defense system, surface to air, that is designed to intercept incoming missiles that are at distance and in high altitudes, and in fact can actually target missiles that are outside of the Earth's atmosphere. And RTX, which was previously known as Raytheon, makes the Patriot missile system, which is another surface-to-air anti-missile system that is designed to intercept airborne targets that would include missiles and aircraft and drones, presumably, at lower altitudes. In fact, I actually was trying to create a graphic that would illustrate this sort of multi-layered anti-missile defense that these various systems are designed to help create. Tried to ask AI with a prompt to generate a graphic, got a fairly amusing response. I mean, it created two pictures, one of the THAAD system. If you go to the Lockheed Martin website, you can learn more about that one here. And if you go to RTX, oops, I didn't put that in, you can learn more about the Patriot defense system. So here's a picture of one of these things here. Now, when he made that statement, the chairman of Lockheed, I'm referring to now, he talked about how they were going to quadruple their production and that they were going to move from a capability of 96 to as many as 400 interceptors per year. And as I read that remark and then was thinking about the barrage of attacks that was happening on so many targets throughout the region, it occurred to me that 400 is not a very big number in terms of the number of interceptors one would have available. Now, the early barrage was mostly unsophisticated. You had UAVs and things like that. So we're not dealing with necessarily hypersonic missiles, although I did happen to see a news release, I think at some point today, that suggested that a hypersonic missile had been launched, and that 10 attempts to intercept it were unsuccessful. I don't know if that's true. I will admit that, I try to source information from the most immediate places available, which might include things like X. It's very difficult to know what is and isn't true using that as one source, especially with AI these days. People can create images and auto-generate content of all kinds. So I don't really want to share any of that because I don't know what's true and what's not. But some things we can deduce logically. And one of the things we can deduce is that if you are using things like the Patriot missile system, and I read that one estimate of this system, if you look at all of sort of the fixed assets, so not just this launcher, but everything else that sort of goes around it, not including the missiles itself, that one installation of this can cost as much as $400 million. And then the missiles that would accompany it to have it essentially have a full complement could be another 600, makes $1 billion. Now, if you are launching missiles at UAVs, for example, so UAVs being basically one-way drones, you put a payload on a drone and send it over, and this seems to be increasingly part of modern warfare, you end up with a very peculiar situation because as sophisticated as these systems are, they're also very expensive. And a one-way UAV, although its payload may not be that high, the cost of that could be $20,000 to $50,000. And there's no country on Earth, or even assemblage of countries, that could plausibly be expected to continue to fight an ongoing battle or war where there's such asymmetry in the cost per engagement between the parties involved. In other words, you don't want to sit there shooting missiles that take, a week to build. Actually, let's just say that in the case of the THAAD system, you're dealing with 96 interceptors per year was the prior capabilities. I don't know how quickly they are going to ramp to that quadruple capacity that they were talking about. But it certainly seems that the number of attacks that Iran has launched is considerably in excess of that. Now, the THAAD system wouldn't necessarily be used to intercept the UAVs that they were sending over. But even the Patriot system, which is the one that we were just picturing, that cost asymmetry is such that you could quickly bankrupt your opponent if you have such an order of magnitude of difference. And again, the orders of magnitude of difference we're looking at are, $1 million per interceptor, not including the launch system, versus a $50,000 incoming. And that's assuming even that you were able to get every single one of those to strike its intended target. You're dealing with, orders of magnitude of cost differential. However, these systems, both the THAAD system and the Patriot system, do seem to have proven to be reasonably effective, and I'm assuming that they are going to need to replace the basically the missiles that they have already used and probably increase their complement, because it is not just the quantity of incoming, but it is also the area that Iran has been targeting. Being as wide as it is, it seems unlikely to me that the existing systems, for example, the Iron Dome, are going to be sufficient to cover the wide multitude of targets that Iran seems to have identified. We're talking about places like Dubai and the aforementioned commercial port in Oman. So one might assume that the demand for these is going to remain very high. The backlog of orders is going to remain very high, and probably going to accelerate. And that may help account, expectations that would be the case, may help account for how well these stocks have done. We'll take a look at Lockheed first. And you can see here that it was in and around this time that we and maybe somebody can correct me on this, but I vaguely remember that I thought it was in June or thereabouts, that we launched an attack against Iran's purported nuclear capabilities. But in any case, basically since this time, we've seen pretty good performance in the stock. But then more recently, that has ramped up significantly, perhaps in lockstep with the associated rhetoric. Now, as this has happened, we can take a look. We've seen that Raytheon, kind of a more consistent. I actually had thought that it was Lockheed that had a more consistent ramp. It looks like it's Raytheon is the one I must have been thinking of. Obviously, these stocks are up a lot. This one is up almost a double off of the post-Liberation Day lows. Kind of curious, incidentally, that stocks like that would have sold off too considerably at that time, but it is what it is. And then additionally, of course, we've seen oil start to creep up. I'm going to look first at the commodity. We're going to look at these things in turn. Oil was flat to actually a little bit lower in December, as you can see here, right? And then right around that first week of January was when that rhetoric about the threat to the regime in the event that they should go after civilian protesters in their own population, and suddenly we started to see oil take off here. And a lot of oil companies have done reasonably well as a result. Let's talk a little bit about why that's the case. So the Straits of Hormuz are a bit of a choke point. And, I think I had, let's see if I can pull this up. I don't know if I had it here, so. Shipping traffic. Is this it? I have somewhere in here, I have a mechanism to look at the location of ships. And of course I forgot the command for it, because this one I don't look at that often. Let me see if I can find it. Where are they? Let's see if we can do this. Again, I apologize. I have a lot of muscle memory when it comes to Bloomberg, but not for this because I don't do it that often. I'm going to see if I can zoom into this a little bit. And we're looking for a very specific area. I'm going to try to get a little closer. And closer still. And here is really what it is that we are interested in. It's this region over here. So this area is the Straits of Hormuz, coming out of the Persian Gulf. And roughly 20% of the world's oil consumption daily flows through this area. Now, I read a report, don't know if it's true, that there are 150 tankers that are trapped inside here, Iran saying that the Straits of Hormuz are essentially closed, and that there's something like another 175 container ships. Now, are they going to try to knock out all commercial traffic through the region? Don't know. But the issue that you have right now is that the merchant marine traffic isn't going to proceed through a region if they are uninsured. They have typically carried insurance for events like this. It's called war risk insurance. What I didn't know and learned over the course of the weekend, and what some of you may or may not know, is that war risk insurance apparently is pretty easy for the insurers to cancel. And that's exactly what they've been doing. They can cancel with 48 hours advance notice. And that's what they've been doing. Now, whether or not you have a crew that even would be willing to pilot a floating gas can through a war zone, there's little chance that the ship's owners would permit such a thing if the ships are uninsured. So I encourage you, you can learn more about this. I didn't actually read this article. These were articles I had been reading over the course of the weekend as I learned a little bit more about this. And you can see more about the companies that are associated with this. Don't have anything to do with Reuters. But Reuters had an article that they published about this. This was updated about 9 hours ago. Emily Chow and Jeslyn Leth. I encourage you to read a little bit about that. Well, if you curtail 20% of global oil consumption, that is going to have an impact. And it's going to impact prices for oil globally. It is a global commodity. But what one should think about doing is having exposure to companies that will benefit from rising oil prices but have a more modest footprint in the affected regions. And one of the companies that one could take a look at would be something like Occidental Petroleum, Oxy. So it's not that they don't have any exposure to that region. They have some. But they also have considerably higher as a percentage of their business exposure to North America, to shale. We're talking about the Permian and things like that. Stock is up a decent bit, as you can see here, as a function of this. And you can see that much of this jump actually preceded this. It's up about 18%. But the other thing that's up in this space is implied volatility. Now, in the case of an oil company, that's not that unusual. As we've talked about on this channel before, if you've been watching, I've talked about this in the context of the precious metals, and I saw somebody has a question about Silj, I think, here. It isn't uncommon for commodities to exhibit a pattern that's a little bit of the inverse of the one that we conventionally expect to see when you're talking about publicly traded equities. When the S&P rises, the VIX generally falls. As stocks go up, they generally see their volatilities fall. Sometimes that's related to less balance sheet leverage, but not always. If you're dealing with a company that has net cash on the balance sheet, that wouldn't be true. But that usually is because the underlying business prospects are seen to be more stable and that you have greater visibility. In the case of commodities, typically supply-demand shocks, which very frequently can either accompany a demand shock or a supply shock and see higher prices, you'll see the opposite. You'll see volatility, both realized and implied, higher, and we see that here in Oxy. So you're contending with these two things. The price of the stock is higher. The price of the options on that stock are similarly higher. And I also I'm just going to expand this just a little bit because I think it's worth just keeping this in context if we can, which is that while it's true that the price is higher, it is still considerably lower than it was. So I think we can sort of say, does this look like we're kind of dealing with a bearish to bullish reversal for Oxy? I think the fundamentals support that. The price action supports that. What's the best way to play it? Arguably, the best way to play it is going to have to be with spreads. You're going to want to do that with spreads because, as I pointed out, options premiums are higher. So if you're inclined to go long and use this as your mechanism to do it, you don't want to get caught chasing high premiums and high prices in terms of the stock. And it seems like it's never going to prompt me to change. It's not. Okay, let's see what happens. We go through this exercise every time, so we'll see what happens next. So what would one do in a circumstance like this? You know, if you were just doing one trade and you were willing to put the stock at the level from whence it came, you know, sort of the standby trade for a circumstance like this might be a midterm call spread risk reversal, let's say. I'd like to make one observation, though, which is that it is possible to do a portion of these trades, okay, a portion of them, and then leg into the other piece. So my thinking is, okay, we're catching a bid. We have a reason for it. This one has better exposure. Put on a call spread with an eye towards using the put leg if you need to, right? So if you're going to have a spread, you don't need to put all of it on at once. So what I mean by that is this thing's up 2% today. It was already up sharply on Friday. It was already up sharply last week. Of course, the stock was much higher a year ago. But still, you might feel like, okay, I'm late to the game here. And admittedly, we are a bit. You know, it's interesting with the benefit of hindsight. I've spoken to a few people today who said, you know, how did we not see this coming? There was a lot of bluster. There was a lot of conversations about this. But, you know, when is something going to happen exactly? We can't quite know. So what would you do here? Buy something like, you know, the first out of the money 50 delta call strike, sell one that's perhaps close to 20% higher than the current stock price, not quite, the 65 strike calls. In this case, you're, you know, going to be paying a little over $2 for a $10 wide spread. Not terrible, probably a little bit reflective of the skew. If you tried to do this in something that had really steep negative skew, you probably couldn't buy the call spread for just over 20% of the distance between the strikes. But that would be a way to play it. Then you basically remain ready in the event that if the stock gives back, let's say by some miracle, this being the Middle East, that we see some kind of resolution in the near term and oil prices settle down. It's probably going to take a lot of the oil companies with it, including this one. At that point, that is when it comes back, and volatility will probably still be fairly elevated at that point because you will have had in the recent past a rapid rally and then a drop. At that point, you would look to sell a put, whatever put you can find, you know, for about $2. And in this way, you're not going to have, you know, any negative carry. Now, on the other hand, if the stock continues to rally, do you need to sell those puts? Well, no, not necessarily. If it continues to rally with the same kind of speed and severity that it has been, you're actually very likely going to get an opportunity to monetize this call through that rally, and then you can roll up. And again, just remain ready to potentially sell some downside puts if and as you need to offset the premium you have. What are you doing when you do this? Effectively, you're trading, we'll say, you know, you're trading some long gamma, effectively, because you have a little bit of gamma, a little bit of convexity. That is the function of being long that closer to at-the-money call. So that's going to have more gamma than the other one. And that, by the way, is another way that you can potentially look to trigger a roll. So I've sometimes talked about if you buy a, you know, 40, 45, 50 delta option and it gets over 60, you've got your finger hovering over the potential roll, gets over 70 almost certainly. But the other thing you can look at if you've already initiated a spread is the net gamma of your position. Because as the stock rallies through your long strike towards your short strike, you're going to go from long gamma to short gamma. Your gamma flips. That is another circumstance where you could say, maybe now's the time to adjust. Why? Because this is a net long options position. Convexity is one of the things you are buying. It's one of the reasons you are paying theta away. If you want to maintain convexity, when you lose it, if and as the stock migrates away from your long strikes and towards your short ones, that can also be a potential trigger to roll your position. Let's take a look, and you're going to observe, if we take a look at Raytheon and the implied volatility there, it exhibits kind of a not a dissimilar dynamic. I'm going to get rid of the realized. You're going to see here that implied volatility here, so this is only going out 1 month, is essentially as high as it has been since that post-Liberation Day high that we saw almost, at this point, almost a year ago. Let's look at 2-month vol because that was kind of the situation we were just looking at in Oxy, and you're going to see that that dynamic is even greater. So a similar strategy could very easily make sense in Raytheon, and for similar reasons. Don't get caught chasing. Don't just buy calls with the stock up sharply as it is today. Now, by the way, I happened to write about this over the course of the weekend. So, if you are, I don't know if it did published on the Options Edge. I'm not sure. It was published on the CNBC Pro website. So, if you're kind of wondering what I'm ruminating about when we're not doing videos, that's another potential outlet. In fact, I'm actually having some conversations with the folks over at CNBC. Who knows? I might end up writing pieces a lot more frequently. And you can see that the same thing is true, maybe even more true. I mean, this is really remarkable. Take a look at what's going on here in Lockheed. This, vol is up really, really sharply. So same thing. Spread. And don't necessarily, I'm going to include the price here, don't get caught chasing. Buy a call spread. Use this higher implied volatility in, as something to essentially, it's not helping you, but use it to the best you can to your advantage, and then look to potentially sell some downside puts. Here, too, you can kind of see, actually, let's look at this. So, oops, I had that. So this is a week ago. You can see just how much higher volatility has gotten. You can also see, in this case, that it's kind of flattened out here. Oh, boy, do I wish I had discussed this with all of the bluster that was going on, because one of the things we see is that there was actually a fairly pronounced skew in here. So those call spreads probably stacked up pretty favorably, but coulda, shoulda, woulda, who knows. But anyway, I think that's an interesting topic given the geopolitical events that are currently ongoing. All right, so having touched on those things, let me start taking some of your questions. Anil asks, thank you for your analysis last week. I have NVIDIA diagonal debit spread. Sold the 170 put, the March 29th 170s, and bought the April 180s. Okay, good. That, NVIDIA obviously did not respond well. Actually, where is NVIDIA now? And I know it did not respond particularly well following earnings. But it seems to be well off the lows. We have, across a variety of funds, we have fairly substantial exposure to NVIDIA, which we would, of course. In the Biggie Fund, that's the, our sort of mega cap, top 50 largest by market capitalization stocks are going to be in there. It's obviously going to show up in that. We have an NVIDIA fund. It's probably got about 1.4 in it. And then all of the semi and chip type funds that have focus. Crypto, you have to have exposure to it. I mean, it's just, it touches anything and everything at this point. So when you take a look at it across the whole spectrum, obviously I would have been happier had the stock performed a little bit better. But, we are getting up into those laws of large numbers. 300, actually, you know what? I should double check. I want to see if this has changed. It was 334 billion anticipated revenues for the full year was the prior number, and that has gone up fairly considerably. 357 now billion. Think about this number, okay? So this is, if we think about that as the full 2027, because you'll notice that their fiscal year ends in January. They're expecting the company's EBITDA to be about 1% of GDP in 2027. I think this is one of the challenges that NVIDIA has here. It's not that the company is losing its relevance. It's as relevant as it ever was. And in fact, according to this, it's only going to become more relevant. But you get to a point where it simply cannot compound at the rate that it has done before it would swallow the entirety of the economy. And that's obviously not realistic. Something that cannot happen will not. And it's not going to do that. And so it will not. Anyway, looking at your trade, We have the stock at 182.5 now. You're along the 180s. This is, you're kind of in the sweet spot. So unfortunately, I don't have a really easy way to wind back the clock because our own charting application, which is the place where I would have done that, we're doing a little bit of work on the site, so it's not live right now. But I'm going to build a calendar spread using options play, and I'll make a similar one. I don't know. We're on Oxy. What the heck? We'll use this stock. It doesn't matter that much which one I choose to use, and I will choose to get long a May 52.5 put, so that we can kind of get it to mimic what you've done here, and we'll sell in April, a nearer dated one, and it'll be a little bit further out of the money. So maybe this 47.5. Okay, so as we look at this, what you'll notice is that it was March, April. Oh, okay, my mistake. So let's do that. Producer just told me I was in the wrong expirations to kind of mimic this. We'll go like this. You're still going to get a fairly similar picture. So your peak profits in a diagonal debit put spread, it was a debit put spread. Okay, so just make sure I have this right. The peak profits are going to be number one at the expiration of the first option, and number two at the level at which the option you own has maximized its value relative to the option that you are short. And the maximum that can be is going to occur at the short strike. So this is not NVIDIA, but for you, that short strike is the 170. Let's talk a little bit about why that's basically the sweet spot. At 170, as of March expiration, the 170 put has no value, right? So if you have the stock's trading 170 and you have the right to sell it for 170 and that right selling is expiring now, the option possesses no value because you can sell the stock at 170 anyway. It has no value. The 180 put, of course, has at least $10 worth of value because it is $10 in the money. 180 right to sell, 170 stock price. But this is also the peak value for the spread. Why? Because the 180 puts are still going to have a little bit of extrinsic value remaining. And the extrinsic value is going to decline the farther away from the strike the underlying stock becomes. And because if it goes below 170, every incremental dollar that the 180s gain in intrinsic value, so too do the 170s, which you are short. But the 180s are losing some of that extrinsic value. So the peak profits that you could possibly get are at 170. What are those profits? Well, actually, I might be able to kind of model that if I do this. So we'll go like this. And the way we can figure this out is, let's assume for the sake of argument that the options, that the implied volatility of the options are approximately where they are right now. So let me just shorten this up. I'm going to look at something that's nearer term. As of March expiration. So we'll call it 1 month, right? So we'll call this, we're going to just say this is a put. And we're going to say that there is 30 days to go until expiration. And we're going to say the strike is 180. And we're going to say the underlying stock price is 170. All right. So as you see here, in this scenario, and let me just double check. I've got all the parameters in correctly. 30 days to expiration. It's going to be round or about that number. 180 strike put. Stock's 170. Implied volatility assumption is 43 here. That's probably a bit ambitious because there's not a catalyst. So let's just quickly see what we think that volatility could or would be. We'll probably use something that's not dissimilar to at the money vol now. Or where it should fall to. Let's call it, so as low as this, as high, let's just pick a, let's take a 6-month average number. We're going to look at 1 month implied. Just get rid of the historical. We don't need that. And the mean's 41.63. All right, so we're going to use a volatility assumption on that day that's going to be in this neighborhood here. Hopefully everybody can sort of see how I'm coming up with that. So we'll put 41 vol. And that gets us to a value of $13.97. We'll call it $14 in round numbers for that put. Of that, $4 is extrinsic premium because 180 strike, 170 stock price, 70. That's $10 of intrinsic. So that's the best or sort of peak situation. All good. But is it a good idea to hold the trade in anticipation of that being the highest potential value that the trade can have? Well, there it gets a little bit more nuanced because is the stock actually going to go to 170? It seems to have stabilized here a little bit. The other thing we want to think about is, does this trade actually give you any, let's assume you're totally agnostic to its direction. Okay, so we don't know if it's going to go higher or lower. We'll say that it's a coin toss. We'll get to the question of whether it is or isn't in a second. But if we assumed it was a coin toss and you were going to put this trade on today, the thing that you would probably care about most is, am I being paid to wait? The reason you put a calendar on in the first place was because you were trying to capture some of that decay. Does this have positive decay? Well, let's check. That's really kind of the question that you want to ask yourself at this point. So we're going to see what the theta on this thing is right now. And actually, I had this loaded up probably somewhere else, but seem to have misplaced it. And you'll be able to see that here. It has a bit, see? So it's calculated to have a little bit of a standstill rate of return. Okay, so this is where we're at right now. Little bit of a standstill rate of return. 58% probability of profit, so that's just a statistical measure. So it's more likely to be profitable than not. But it's more likely to be profitable than not because of that little region right in there. And is that enough to justify, the worst case risk, which is this area over here, and the worst case loss, which is this area over here? I think it's okay to wait a little bit longer, but this is the number that I would keep my eye on. Do I have a little bit of a tailwind? And that will go away because if I draw I should probably have a blank screen for this. Let's see if I can come up with one. So if I draw an axis like this, where this is the value of the option, and this is the number of days to expiration from 0 to infinity over here, an option's rate of decay accelerates as expiration approaches until a point. Down she goes. What's happening here? At a certain point, an option becomes close to worthless. And so even though its rate of decay relative to its own theoretical value is accelerating, its actual value is so low that its decay in real terms is de minimis. It's effectively nothing. So what you want to do is monitor that. And the moment that that crosses over so that your standstill rate of return goes flat to negative, and you can see that, just take a look at the theta of the option you're short, the theta of the option you're long. If the positive theta is less than the negative theta, now you're bucking the tide. Now you have to paddle. Now things have to happen for you to be profitable from that point forward. And that's certainly a point, certainly in a trade that even though it was a debit, was intended to be positive theta. That's the point when you might want to think about changing it. Okay. Let's bring some of these charts back. I have a chart. There's something I can do in Bloomberg, and it shows me where every ship is. And I used to use that all the time, but now I don't use it at all. And so consequently, there it is. Now we got our ships, but I don't want all the ships. I want the tankers. So I just want tankers. There you go. So you can kind of see what's going on here. Glad I was able to pull that up at least. But you know, this is a meaningful choke point over here. Okay. Times they are changing. Mike, what's your opinion of SilJ? So silver obviously had that huge run up. Then it gave a big portion of it back. We're back on trend. And I kind of feel like the basic thesis for the metals remains intact. Obviously, it's not doing well today, but even at these prices, down as sharply as they are from where they were, silver miners are well positioned, and I also like it as a generally non-correlated asset. We continue to hold. We hold a couple other things, right? So we hold the gold miners, we hold gold, we hold silver miners. I don't think we have any current exposure to the metal itself right now. Okay, I have snaps, SEP 360s. Today, wait a minute. Am I? No, I did not. That's first of all, that's the wrong. Yeah, I know. S&P. Am I reading this correctly? I have a SEP 360 long call. So deep in the money, that's this. Today I bought back a March 460 short call. Okay, so you had this, but now you're flat. What do you think of the trade? Do you think IGV has bottomed for the time being? So, oops, I'm reading two different lines, sorry. Bought back the 460, that's a problem. Bought back the March 460 short call. So, by the way, this is not the same calendar. I should probably be putting this into options play because Bloomberg doesn't give me a good way to visualize this with all of you. All right, so you've got the SEPs, 360s. You were short. I'm going to put the Marches in that you were short, and then we're going to cover it. All right, so long 360s. These were not the 360s. These were the 460s. So you had this. All right. So that's the trade you had, which was fine. It's kind of a buy right of sorts. A bit of a buy right. It's sometimes called a poor man's buy right. Deep, longer dated, along a deep call that's longer dated and short calls against it. And you migrated that to the April 170s. April 470s. So you went from that to this. Yeah, I mean it's fine. I don't think there's anything wrong with the trade. Not sure it made a huge difference, but it's fine. Lot of capital committed to those 360s and SEP at this point, which is okay, I guess. You are also going to find yourself at a point where those are, as April begins to approach, those aren't really long dated anymore. I mean, they're kind of intermediate now. We're looking at like a 6-month option. But as April approaches, and I'm assuming that you're going to adjust the Aprils in much the same way that you're adjusting the Marches now. I haven't done the work myself. I know that Tom Sosnoff and Bat and the other folks, when they were at Tasty, that by their work, they were finding that probably the most efficacious time to adjust those positions was in and around the 3-week time frame. So, you're basically looking at a 3 to 4 week holding period with a 3 to 2 week days period to expiration when you wind them off. So, you're basically adhering to that, right? Because you took the Marches off now, and it's March has just begun. So, in terms of process, I like the process. So yeah, I think it's fine. Yeah, I'm okay with that. Steve Garcia asks, IGV has fallen to support for now. I recently sold several April 80 puts for 405. What do you think of the trade? Do you think IGV is bottom for the time being? So I believe I commented about this last week. I'm not 100% sure if I commented it on the live stream. I was also on Fast Money on Friday, so maybe I brought it up then, or it was in a different context. If I didn't bring it up, I'll just go over what I was thinking now. And that was this. So we had a remarkable underperformance in software versus technology more broadly as we look from the second half of last year onwards. So we're going to just look at this in segments. I think you might find it interesting if I didn't share this with you before. So we're going to put XLK in as sort of a broader technology proxy. And let's take a look at how this performed from the end of 2024 to the end of the first half of 2025. They literally tracked almost exactly. So the total returns, we're rounding errors here. 10 basis points different. Okay, so, and software is a reasonably big component of technology broadly, because that is going to include names like Microsoft, which is one of the top 3 largest companies. Okay. Now let's take a look at what happened between that date and the end of the year. 17.5% underperformance in 6 months. That's pretty profound. We're looking at 3%, 3% a month, basically, of underperformance. That's pretty abysmal. And then even more amazing was actually the degree of underperformance from the end of the year through... Actually, I needed to go back further than that because I need to go back to the 25th, actually. Or the 20th. The 20th. 21.5% underperformance just in the first 2 months, basically. But last week, it did look a bit as if maybe things were starting to turn around. So we'll just advance the clock here. And it caught a bit. So my view is, yeah. And look, there is a big and important narrative here. So there could be, And that narrative is that AI is going to lay waste in the software space. That's one part of it. There is another part of the issue that's going on, and I think we're going to delve into this more tomorrow on Office Hours with Professor Mark, and that is that there is also a lot of damage being done in the private credit markets with software. So some of you may have seen, maybe you didn't, or haven't been paying attention, or you don't have exposure to private credit. Private credit is, the credit adjunct to private equity, area that has grown by leaps and bounds in recent years. And a lot of lending has been going on to software companies in that space. We'll talk about what the implied rates of default would normally be given the rates that those portfolios have typically been paying, but they're not investment grade. And the issue in that space is that software companies, unlike sort of more traditional businesses, don't have a lot of assets. So if the software company goes sideways, the problem that you have is that there's not really much recovery for the bondholders. So I think that is spilling over into the public software space as well. And I'm not sure that it deserves to. It has actually occurred to me, I thought, if you have successful publicly traded software companies and there's would-be competitors that don't have positive cash flow, that might be on the ropes, that are going to be on the chopping block or on the auction block, is that bad for the publicly traded software markets? Because that's what IGV is. And on balance, I would have to think, well, either that's going to reduce competition, provide them things that they could acquire on the cheap, or maybe some combination of those. So whatever you happen to think of software in general as a function of the AI trade, the separate dynamic of what's going on in private credit doesn't seem like it's a headwind for the publicly traded space, particularly those with significant positive free cash flow. And Microsoft is one of these stocks that has grossly underperformed. We'll just take a quick peek at that one. Let's do Microsoft versus Micron. How about that? Micron's obviously pretty easy to pick out a real heavyweight. Look at that. How's that for some underperformance since the beginning of the second half? It's underperformed it by, only 255%. I think that, have we hit the bottom in software as service and so on? I don't know, but the money flows last week suggested that it was going to catch a little bit of a bid here. And if you're looking for things within the tech sector that are going to be cheap, it's probably going to be found in those areas that have sold off a little bit, assuming that their top lines aren't deteriorating. And I don't know that in the case of, say, a name like Microsoft, that's the case. I will offer, though, that a big in the publicly traded software space, a consideration that's worthy of note is that companies like Microsoft, which are, halo companies because they have phenomenal and consistent top-line growth and great margins, and a big part of the story has been that they are asset-light businesses. And, Warren Buffett, I think, had said that, if he could buy only asset-light businesses, that's all he would ever buy. Doesn't have an interest in buying businesses that have to invest tremendous amounts in fixed assets that aren't really creating anything. But the issue I would point out with that narrative for companies like this one is right here, which is it really an asset-light business when you start seeing CapEx like that? And that CapEx is not CapEx so that the company can basically create a new product that they can then turn around and sell with no incremental unit cost. No, this is an investment in hardware, and hardware that deteriorates, hardware that becomes obsolete. So it's a different kind of a business. Does it deserve the same multiple? Probably not. But it's also not trading at the same multiple. So, what are we trading? Around 20 times forward earnings? It's not terrible. This being arguably, you might as well look at the biggest software company. We're going to look at software, right? Okay. Dimitri Caldwell. Hey, Mike, I just started reading your book, Options Edge, which led... I'm currently studying the concept for term structure volatility. This book is a great read. Well, thank you for that. Thank you. We only have one edition out there. There is one formula error in it that an eagle-eyed reader managed to capture. I mean, there will be errors. This is one thing about you publish any work. I don't care whether it's a 250-word quick trade idea, a 500 to 750-word article. You can reread your own work a multitude of times, and you will always have typos or errors in there, and you will never catch them until it's actually published. And then it'll just stick right out. It's amazing. It is absolutely remarkable. If you want to see the errors in your work, publish it, and the error will come right out. It'll just pop out, in highlight for you. Actually, it was a reader that caught it in that case. The formula, if my memory serves, and the only reason I'm saying, if my memory serves is because it was a little while ago. It's early in the book. It was in the exponent, I believe, for the put formula. There is a sign in the exponent that is incorrect. So if you're busy putting all of those formulae in to your Excel spreadsheets and you're wondering why that one doesn't come out, that is the reason. And we haven't published another edition, so I can't correct it. But I haven't been made aware of any other errors in it. And yeah, and as you know, we talk about term structure quite a lot. So the term structure simply is this chart right here. It's very important to options traders. It's very important when you're looking at events, because this is going to reveal, when things are going to happen. Right? So you can tell that there are events coming up because the term structure reveals it. And you can sometimes exploit opportunities by trading around those events. Another quick point I would like to make, and this is just a reminder for everybody, that there's a tendency, I have seen this said many times, where people will say, and I say it sometimes in a general sense, but I want to make sure that everybody who's watching understands the caveat that's involved here. And that is that when implied volatility is high, arguably you want to sell it because volatility is a mean reverting process. That idea in isolation is probably an okay one to have. But the important thing I would point out here is that because these are high and these are low, does not necessarily mean that you want to sell these and buy these. Because volatility itself, the realized volatility of the underlying asset, also tends to follow a pattern where it is going to move more at some times than others. As you see here, you can see that there was a process in here where the volatility was much lower and one in here where it was much higher. This one doesn't matter because this is actually Liberation Day stuff. But some of these others actually can be related to the events. One of the interesting things that sometimes happens is you are sometimes better off selling volatility between known events, even though the implied volatility, the price of options, is lower, and buying it through the events. And the reason is because since so many people think, okay, it's just a mean reverting process, they don't want to sell volatility too cheaply, even though the underlying stock's barely moving. As you can see here, all in here, the volatility of Microsoft from early June all the way through the end of November, volatility during that period of time was below 20. And the average, actually, let's see what the average was. I'll bet you this is going to be pretty interesting. So this is going to be, let's say June 15th. Let's go June 15th of last year through November 15th of last year and see what it looked like. Mean volatility, there you go, less than 16. Right, so that was the 1 month mean volatility. And let's see what it was for, the market. There was a lot of dispersion in the market. Dispersion meaning a lot of stocks were going up and going down violently. Maybe the market wasn't doing as much. But let's see how that compares to S&P for the sake of argument over the same period. or maybe we won't because this thing won't do anything. Go. There. So that was 11. All right. So the Microsoft was only 40% more volatile than a huge diversified basket of large cap stocks in different businesses. So you'd have been very happy to sell what would probably have looked like cheap vol. If you'd sold 20 vol for that whole period, you won. You won. So believe it or not, sometimes you actually collect more of the volatility risk premium. That's the difference between the price of the options you sold and the realized volatility of the underlying asset upon which you sold them during periods of low volatility than you do during elevated implied volatility. In fact, oftentimes realized volatility can shoot through implied, and people won't pay it. You'll see, the VIX goes to 80. Does S&P 30-day options and 60-day options get to 80 vol? Not too commonly. Why? Because people are expecting the real process to actually revert to the mean as well. So just as you look at the term structure, just remember that. When vol is high at discrete moments in time, there's very frequently a region for that. Laura Berg says, do we get a prize if we find the error? So I should pay for the mistake as many times as possible, or Mark and I should. Maybe that's not a bad idea. If you can find, I have already told you what the error is. It was in the exponent of the put formula. But if you can find another error, identify another error that's not a grammatical one. Okay, so we make grammatical errors, and they didn't have Grammarly back then. So don't look for grammatical errors. But if you find a technical error, I think we should have a prize for that. I don't know what that prize will be. I'll think about that. But that's a good idea. That's a good idea. Man, that's actually a good idea for editing, because I actually think that the editor, half the time I think the editors aren't really reading this stuff. They probably put it through their own version of Grammarly, and they're never going to cross-check the formulas because they don't understand. What are they going to do, sit there and program the stuff? Probably not. Okay, KJ Lemur, oh man, a few times I wrote my watch list post the night before I was tired, completely botched the levels of the tickers. That will happen. That will happen. Okay, well, folks, as always, I appreciate your time and attention. I'm glad that you guys tuned in. And I also appreciate those of you who might watch this recorded instead of live. So I'd very much appreciate a like, a subscribe, questions or comments in the video, not the live chat, but if you could put them into the video itself, because the live chat, it's not easy for us to go back and find those questions. But if you put them into the video, then hopefully Mark or I or somebody else can try to answer them in a future video. And we will have one of those tomorrow at 2 o'clock Eastern time when I'm joined by Mark Guthner, and hopefully we're going to talk a little bit about private credit. That's going to be a continuation of the software story, because a lot of the companies involved are indeed software companies. So until then, and as always, thank you very much for watching. See you soon.